It is November 7th, and this is the video log that takes 30,000 to a million. After I do the account review, I will talk a little bit about just some screening fun that I've been having and some of the companies that amazingly popped up while I was looking through the results. But first, let me go into the account. Oh, that is not the account. So you're just gonna look at me for a second while I fix this issue. But there we go. So this is the account. I'm gonna go through the account and list all the positions. Actually, I'm just gonna show them to you. You can view all the information yourself. This is the options up at the top here on the right. You'll see the symbol, the strike price, whether it's a call or a put, expiration date, number of contracts, and whether it's a sell or a buy. On the right, you'll see the daily change in dollars and percentage as well. I'm gonna scroll quickly so you can pause the video at any time, any moment to figure out my exact positions. You'll see that some of the options are expiring soon here on the 19th. And I've bought some calls. I've sold some calls. It's very interesting. These are the stock positions here. Apple was about flat today. EBIC's been gaining like crazy. Actually, I need to review EBIC's here, but I have it set to sell at 35 and 45. I have some options that I've sold, some call options. So Alibaba, JD, not a good day. And then the rest of my positions, I picked up a little bit of SH again, just as a little bit of protection because the market's getting pretty overvalued. So I might be putting some money into SH soon. A lot of these option contracts are about to expire, so I'm going to get a lot of my collateral back, and then I'm going to have a good hard look at, like what I need to change, how conservative I need to go from here on out. But instead of going conservative, what I've started doing is actually just looking elsewhere around the world. Like, there's always something bad happening at some part of the world, so maybe look for opportunities there to like sell some puts and try to accumulate a position that just makes sense. And so that's kind of what I've been going for. But I don't know. The US is still probably the best market out there. So if I can find some opportunities in the US, I'd like to give them a shot. And you'll see that I may have found through the screener some opportunities here. So let's keep going with the account. So these are all my equity positions here. If you want to see the account tab, we can take a look at that as well. $226,000 under management here. 36,000 of those are margin, which is pretty low. It's only 16.23% at the moment. If you want to look at the positions that are still in the account, this is sorted by total return. Apple, EBIX, Realty Income forming the top three. And then by size, Apple, EBIX, and JD. Rounding up the number 3 place here. Realty Income is at 4. So my biggest positions are almost my biggest gainers as well at this point, which is cool. Which only tells me that what I've been trying to do over the last few months is probably the correct thing to do, which is just focus on the names that I have the most conviction in and the place that I'm currently trying to make money off of, and just ignore the rest. Just get rid of all, not garbage, but all the smaller positions that I don't understand as well, and just focus on the ones that I think I can make money on. So that's kind of been my strategy, and I want to stick to that and continue to improve. So now that you've seen the account, I want to talk about the screener that I use. I like FinViz because it's free, but I should really pay for something that doesn't have ads. I have nothing against FinViz, but it just says ads. I don't even know if they have a subscription service. They might. I'm gonna go into it right now and we'll take a look. But nothing obvious actually that stands out right away. So let me see first of all how much of this you can see. Okay, so maybe I need to adjust a little bit. Maybe I don't. How about I adjust it for you? So capture window. How about we do this? So you can see more clearly what's happening. All right. So what I've done here is, as you can see up at the top in the yellow markers, actually we'll make it a little bit like this to zoom in it just a bit. Okay. So the yellow fields is what I've edited. I've done some fundamentals screening here. Basically anything with under 10 PE, a positive earnings per share expected in the next 5 years, positive return on equity, forward PE that's profitable, sales growth in the past 5 years positive, return on investment positive, gross margin positive, EPS growth this year positive, EPS growth quarter over quarter positive, operational margin positive, net profit positive, return on assets positive, and EPS growth in past 5 years positive. So basically what I've done is I've just tried to find companies that are under 10 PE and they're not complete garbage. And this is a list that Finviz came up with, which is 54 companies. And I've sorted them here by lowest PE. And amazingly, the first three of the four are Brazilian, and one of the four is a Luxembourg steel producers. So I thought that was pretty interesting. Um, Now, all their charts look very similar, and I think most of the recent downturns. So let's just click on the biggest one, which is the Vale or Vale, Vale. Um, it's a Brazilian materials and mining company, but all their charts look very similar. They just started having a downturn since August. I'm guessing it's because of the Chinese slowdown, and in fact, I think that Brazilian steel industry is pretty correlated to China because let's click on this one actually. How about this one? Gerdau. I don't know. GGB. I think it's pretty correlated with China economic activity actually, because this chart right here looks a lot like a lot of the Chinese stocks, including one of my favorites, which is VIPS, which I wanted to talk about today, but instead we're going to do this. So it's only down like 50% almost. So it's not that big of a drop yet, especially for, I'm actually being serious when I say this, especially for a materials company, and even one that's this specialized. So anything that's revolved around commodities, materials, cyclical like that, there's a big fluctuations in price depending on what's going on in geopolitically and whatever, or geoeconomically rather. So first of all, let me see if I'm recording voice. That's very important. Okay, I am, which I had an episode where I didn't record the voice and I had to delete that. That was bad. It was a good one too. I wish that the sound was on. Regardless, this is the company, and you can see how the chart looks very similar to the Chinese stock market in the last year. So I'm guessing it's very correlated to Chinese building materials activity, and since the whole Evergrande fiasco and all their other construction companies are in trouble, they might be defaulting, some of them might be going under because for various internal reasons. Brazil is feeling the heat. They've had a shortage. There was a shortage of materials at one point in the year, early on, and now I guess there could be a surplus. So naturally, these prices are coming down. But no one, I mean, I don't know. I'm sure somebody knows, but I don't know where their bottom is going to be. But if they were making money at the previous space, then the price to earnings company of this ratio of this particular company would be 3.25, and the forward P would be under 1. So just to put it in perspective, guys, the forward P of under 1 just means that under a year you can buy the entire company with the earnings you make on that year. That's what that means. It's quite amazing. So, okay, back to the screener here. Something that I really like too is I look at all of these ratios, all these percentages here, like the return on asset, return on equity, return on investment, gross margin, operating margin, profit margin. I want them to be healthy and positive, and certainly have been, but you know, we can't expect the cyclical company to go at this rate forever. So there might be a huge correction, and these numbers will not look that good anymore. And it looks like a lot of traders there are thinking that they're calling the top. But the thing is, if this is not the actual top here in May 2021, then there's a big upside to be had. Like, if the Chinese economy is not in shambles and construction resumes, picking up the slack of these broken companies, then there's a big upside, I think, for some of these cyclical stocks. Now, I'm not a big expert on steel at all. So if somebody knows a lot about the supply and demand of steel worldwide and wants to shed some light, especially China and US and Europe, which are the biggest importers of that, for some of these Brazilian companies, that let me know in the comments what your opinion is, and most importantly, like where I can find some more information about this. But moving on, there are some pretty interesting surprises here. Besides these top 4, it looks like most of the other companies are USA companies. One that stood out to me is Smith and Wesson. I actually used to shoot Smith and Wesson 1911s, and I loved them. I thought it was a very good pistol, so I actually like this company. And then I clicked on it, and I noticed this little tiny mini bubble here in July, and then the price has been basing ever since then, so it could be poised to increase. I'm not a technician, but this kind of looks like a big basing period after initial bump, so this could have a parabolic move in the next 3 months. Not a technician though. But look at these numbers, right? So price to earnings, of course, may be unsustainable, but who knows? Actually, this is not that cyclical of a stock. So 4.19, crazy. Forward P of about 8. These look good. Price to sales of 1 almost. No debt, virtually. Pays a dividend, 1.5%, and it's only 4.3% of the money they have, so it's really insignificant to them. So they could actually quadruple this dividend and be fine. You know, they'd be fine. So look at this though. Remember how I just told you I really care about these metrics here? We got 64% return on assets, 108 return on equity, 88%. Is that 80? 80% return on investment. Gross margin 44, operating margin 32, profit margin 25. That's quite high for profit margin. Very surprised. And stocks is actually not doing that bad. It's 44% off its 52-week high. However, it's above its moving averages. So again, not a technician. So actually, I'm not a professional at this in any shape or form, by the way. I'm doing this just as a personal journey, and everything I say should be taken as a grain of salt. I'm just out here discovering everything just like you are, and I don't charge anyone for anything. really. So I'm definitely not a professional. Just this is just a personal journey, and I want to record it. And if anyone else is interested, that's great. That's fantastic. So, anyways, back into the and none of this is financial advice, of course. If by some odd reason a lot of people see this video, make sure that you're making your own decisions and you do your own due diligence, and that you could lose your principal and a lot of money in the stock market. So be warned. Okay, moving on. So that's Smith and Wesson. I really like this. I'm actually buy this company, or at least sell some puts against it if they're worth it. I actually checked it out, and it doesn't look like they pay a lot. So I may be better off just buying the stock. It looks like it's bumping against some support here. Again, not a technician. So Smith and Wesson, that was an interesting surprise. I like that. An American company that I like. Another surprise was Goldman Sachs, guys. Like, you wouldn't believe it, but actually Goldman made it to the list. Not because it's been dropping in price, but honestly, it's because its profitability is so damn high. Like, it's pretty incredible, but this company still rocks amazingly. Like, it was a really good buy, but it was a little pricey. Pricey in terms of, like, it had ran up quite a bit. So this is the chart for Goldman Sachs running back like a few years here. This is the March 2020 drop. And I thought, once it started running up here at 300, I wanted to buy it. And I'm like, okay, it's looking like it's more expensive than the other companies. Like Bank of America hadn't had a run up, and all these other financials. So I just started playing around with them and selling puts that never hit, obviously, because of this crazy run up. But now it's at 407, $100 higher, and I'm thinking like it's a better deal now than it was $100 earlier. So look at some of this, right? I mean, it may not be sustainable. We don't know. I mean, I don't know. But PE of 6.72 is crazy. Forward PE of 10, fine. Price to sell is 2, whatever. Margins though. Gross margin 83, operating margin 42, profit margin 33. Return on assets quite low, but that profit margin, return on investment low as well. Price target for the analysts is 451, which is almost 50 points higher than here. Some of the technicals look okay here, I guess. Let's see if this does. No, it doesn't draw charts for me. Okay, whatever. But some things to note here is debt to equity is high, but it's not so unusual for finance companies because they like to leverage a lot what they do. And long-term debt to equity is also fairly high. I like to think of it this way too. I like to look at the raw numbers. So the market cap of the company is 136. Let me see if you can see clearly. Okay. It's 136 here, 136 billion. And its income is 21 billion right below. Right? So I just like to put it in perspective. So if I invest, $136, I get $21 in earnings by the end of the year, and they can decide what to do with it. Currently, they have a 2% dividend, which is not horrible. And guess what? Their payout ratio for that dividend is 9.4%. So they can make that dividend really, really easily. They could double it from here if they wanted to and be just fine. They can just be fine. Or they can just reinvest the money. Like, that's fine. 2% dividend is great. So I actually think Goldman Sachs makes a ton of sense at this price point for, oddly enough, I would not be opposed to buy Goldman Sachs. I'm a fan of money, and they're a fan of money as well. Investment bank, they're great. Okay, so moving on. So far, interesting surprises: Smith and Wesson, Goldman Sachs. Moving on to the second page. Um, a lot of telecom companies, of course, but that's common, because utilities, they tend to not grow very fast, and they just kind of collect paycheck and pass it on in form of dividends to the investors at this point, especially if they've grown to where they're going to grow. They've bought up all the competition around in their own country, and now, it's now they're just collecting paychecks and passing it on. Um, some other interesting, there's another mobile that I actually owned for a little bit, the Russian telecom company here. Some gold miners. We got Anglo Gold, Ashanti. I used to be very much into gold miners. Now I almost have none. Um, I'm waiting for some kind of really big correction. In fact, a bear market in gold until I start accumulating some old gold miners again. But they were looking really good last year, and I should have owned more of them, but I didn't. So, and there's more. There's another gold company right here. Both of them South African. Personally don't want to invest in South Africa because it's just a problematic jurisdiction at this point in history. But the other surprise here is Intel. So, Intel, guys, a tech company, uh, granted an old tech company, a 50-year-old tech company, but it's a tech company. Like, they make microchips. Like this computer, my computer here, this HP Omen beast with a 390 NVIDIA card, and I don't know, i10 something process. Who the hell knows? But that processor is Intel. The CPU is Intel. So they still make cutting edge technology for, you know, I guess at least for PCs. From what I've read so far, the two companies that are beating Intel in technology at the moment when it comes to the microchip are TSM, which is what is it, Taiwan Semiconductor something, and Samsung. I think are the two companies that are beating Intel in technology right now. But Intel they're supposedly investing a lot of money to build like new plants and hopefully attract new talents to drive their company forward. But I mean, we'll see. So their PE is under 10. It's 9.89. Forward PE is 13.74. The dividend is 2.73. The payout ratio is 26.5% on that. So they could double it, I guess, but probably not a good idea. Margins, though, are looking actually fairly healthy. You got return on assets of 13.5, return on equity of 25.1, return on investment 16.6. Gross margin is at 56.3, 25.9 for operating margin, and profit margin is 26.9, which is huge. I mean, a profit margin of like over 25, I'm pretty amazed at. So that's great. Looking at their debt, not much at all. They're not burdened by debt either. Their numbers are fairly healthy, actually. And they do have a lot of employees, though, which I don't actually like because it weighs on Intel. I mean, not only does it increase like litigation risk, but also employees are very sensitive to like increases. I mean, you're gonna have to increase the wage of these people like fairly frequently. So especially if you want to keep some of the good talent in or pay in perks in some way. So a lot of employees to me is a bit of a problem. 110,000 for a market cap company of 204 billion. I know that's not a good comparison, but I like to it's better for me to visualize that. I think a better comparison supposedly is of course the employee per revenue, I think, or something. But Anyway, I like to look at market cap per employee. So it's quite a bit. I've seen worse. Like I think Bank of either Wells Fargo or Bank of America had some huge employee numbers. Well, actually, the Chinese companies, JD and Alibaba, they have some huge employee numbers for the size of the company. But that's just because they're undervalued, and also in China the wages are a little bit lower. So Intel, guys, there you go. Those are the finds. So Smith and Wesson, Goldman Sachs, a premium company, and Intel in this list of under 10 PE companies, rounding out the bottom of this 54 company list. So anyway, that's the update of the account, and hopefully you either got some interesting ideas or enjoyed me getting interesting ideas from this Finviz screener. I'm going to end it right there. Hopefully I make another video next Sunday. All right. Peace out.